What if you get a flight ticket from Hyderabad to Chennai, which is much cheaper than a train? Would you go? Yes, of course. Why? Because you will reach faster at a much, much lesser price. And in investing, aggressive hybrid fund is exactly like this. You get higher returns at less risk over a long period of time. So this is the beauty of this product called the aggressive hybrid fund. Through this analysis, I have personally benefited a lot, and I hope you will also benefit. So I'm going to cover here in this. I'm going to talk about what is an aggressive hybrid fund, why is it different than the other hybrid funds, compare it with the large cap fund, performance, and the other risk parameters, both 5 years, 10 years. And then I'll take you through a real example of real funds, the last 10 year with the last 10 years data, and look at their performance 1 year, 3 years, and 5 years. What is the ideal time? What is the ideal time period to invest in a aggressive hybrid fund, and who can invest? What kind of investors can invest in this fund? And what are the kind of returns it has given if you had done an SIP in the last 5 years? All this I'm going to cover in this short video. Watch till the end. Lots to learn, good insights that you would have not probably read, or if you are new to this category of fund, there is a lot of learning. Hi, I'm Franky Fernandes. I'm a certified financial planner and I'm a marriage coach. My goal is to help young families grow their wealth and also grow their relationship. I'm also the founder of Harmony and Money. It's a community for young families where they learn how to save, invest, and adopt good disciplines. And I do a webinar every Sunday around 7 p.m. Check the link, register, and join the webinar. In this 90-minute webinar, I uh, talk about the challenges that young families have in saving, investing, and how to get rid of debt. The link is provided in the description and the comments. So let's get started on today's video. A very interesting video. Aggressive hybrid funds is a category of funds among the hybrid funds. And what are hybrid funds? Hybrid funds are basically a combination of equity and debt, right? That is the basic fundamental difference between a equity hybrid and a debt fund. So let's take a look at what are aggressive hybrid funds. So by definition, the aggressive hybrid funds are a category of mutual funds that strategically combine equity and debt investments to offer balanced growth with risk management. And that is the hybrid funds, the definition of aggressive hybrid funds. And these funds are mandated by SEBI to invest, please note, 65 to 80% of their assets into equity. That means the money that you invest in hybrid equity funds, 65% to 80% is invested in equities, and the remaining 20 to 35%, right, is invested in debt securities or money market, right? So the broad categories: equities and debt. Equities are high risk, debt are low risk but fixed income, steady income. So they combine both these and they come up, and that is the hybrid category. And here it is the aggressive hybrid category that we are talking about. So what has been the performance? So in the last 3 years, the performance has ranged from 14 to 23% in a hybrid fund among the top performers, and the average also is not really bad. And 5 years returns is ranging from 16 to 27%. So this is the kind of returns aggressive hybrid funds have given. And many funds have delivered between 15 to 20% annual returns over extended periods. Now, this is the highlight. This is the most important part. And this is the a very important aspect of aggressive hybrid. And this is what actually motivated me to do this video. Uh, let's take a look at the performances. So there are these 5 top funds that we will take a look at, and I want you to take a look at the returns. So here it's 18 for 3 years. Here also 18. One is 23, and the other two are 15%. 5-year returns are more interesting: 22, 21, 25, and 19. Which means if you had invested a lakh 3 years ago, you would have got 1,65,000 today on an average, not the top performer. and you would have got 2.5 lakh in 5 years, which means more than double in 5 years. That is a kind of performance. Now, talking about the tax benefits, they have exactly the same tax benefits as equity funds because more than 65% is into equities. So, exactly the same 20% short term, long term 12.5%, beyond 1.25 lakhs. And the dividend is taxed accordingly, as, like it's in your income slab. So this is about the aggressive hybrid funds. And and this video, I'm sure, has motivated you to watch this video because of the thumbnail which said aggressive hybrid funds have performed better than large cap funds. So that is the main reason. In fact, I also wanted to do this video because I was shocked when I was looking at the returns in the last 5 years, and when I just compared them, and a large cap and aggressive, and I said, wow, aggressive is higher than large cap. That is what made me do this analysis. And let's take a look at these two funds and compare them. Some of the top. Yes. So here you have the aggressive hybrid funds, and here you have the large cap, right? And let's take a look at the 5 year performance, right? So the top fund here, Quant Aggressive, has given 23.15, and JM has given 23. Then we've come down from 21, 20, and 19, almost 20. That means above 20% the top five funds have given. And I just mentioned that the other funds also are in that range, above 15%. Now let's take a look at the large cap. Now, large cap, the top fund is 20.9. And here, if you see, four of the hybrid funds have even beaten the top large cap fund, Nippon. And the other large cap fund are 18, 15, 14, 13. That means this category of funds has really, really given above par returns. And what is the reason? How come a hybrid fund which has got only 65% equity or max 80%, and here you've got large cap which is 100% or maybe little less than 100% large cap equities? How come hybrid has beaten large cap? I'll share about I'll come to that, but before that, let's take a look at some of the other comparisons. So here is we're looking at the average, and here we're looking at the top performer. So even among the average funds, if you do an average of both the hybrid and the large cap, the hybrid is here above 15%. That is probably 18 to 19 average, but the large cap is around 14%. 14%. And here, the top performer fund is about 20. That is 23, 24%. And the top performer is around 20 plus in large cap. See the gap in 5 year. Now, whenever we look at performance, returns, the other side of the return, the other side of the coin of the return is risk. So if this is the returns, this is the risk. And higher the returns, higher is the risk normally. That means you take high risk, you get high returns. So here, the hybrid funds have given much higher returns than large cap, which means hybrid funds have taken higher risk to get the higher returns. Is that correct? Let's take a look. See, here is this is the returns, and this is the volatility for large cap. Just compare large cap and aggressive hybrid. See the returns, extra returns here, but see the risk. There it is taking extra risk but low return, less risk but higher return. How is it possible? What is the magic in this fund? We'll take a look at little while later, shortly. Here is that risk adjusted. Here, the risk adjusted ratio. This is the ratio. This is the ratio. Higher the ratio, better the fund is in terms of its risk efficiency. So this is what the extra which you see here, which is lacking here. This is so efficient. And that's the reason it is. And despite that, it has given high returns comparatively. So interesting, right? Less volatility, high risk adjusted ratio, and high returns. which is actually an anomaly, which means it is not normal. It is counterintuitive. It is actually, uh, it is basically going against some of those basic norms. And it is interesting to know why. And I'll come to that. This is best understood if you take a year on year from 2020 to 2025, because a lot of things have happened in these 5 years. And let's take a look at the large cap and the hybrid, how they have performed in the bullish market, in the bearish market. And this will really, really help you, give you deeper insight into this product. So here is from 2020 to 2025, and these are some of the market conditions. For example, in COVID, we were recovering. So the returns are 12.5%, lower than large cap. Yes, there is an initial lag here. Okay. Now we'll see as the bull market, as we see the bull market in 2021 and 2022, sorry, in 2021, and then the bear market, how has it performed? In the bull market, it was 32.8%, and against large cap, 20. That means there is a 4.3% upside. Then the bear market, the markets fell, and the returns fell by minus 8.2. That returns fell by 8%. But here the returns fell by 12.5%, which means there is a downside protection. And why is this downside protection? Remember that it has got around 35 to 20% debt, fixed income. And that is the cushion that it gets in the bear market. And then when 2023, when it recovered by 18.5 against 16.8 large cap. There is a higher recovery here. And then again, the bull market in 2024, again 24.2 and 2020, 22.1%. And finally, when the market was so volatile in 2025, we know that 2024, in October, the market fell and it came up in December. Then again, it kept on falling in March. Very volatile market. And in that phase in 2025, it is given 5.24 as of properly, as of maybe July, August. And here it is only given 3.2. Except for the COVID, when it was recovering, which is an exceptional situation. See the rate, see the returns that uh, aggressive hybrid funds have given. Very impressive. And this shows us that any market conditions, aggressive hybrid funds are superior to the large cap funds, especially in the short run. And we will take a look at even beyond. Now, the question that I had and the question that you might have is last 5 years were exceptional. COVID recovery and then bull run, bear run. It was especially the COVID recovery from there till here, till 2025. Most of it has been bull and very less of bear market. So probably 5 year is not, we can't make conclusions on 5 years. And I agree with you. We cannot make conclusions in the last 5 years. So let's take a look at the 10-year period. And that is going to be interesting. The Sharpe ratio, the Sharpe ratio. Here the Sharpe ratio is high, and here also it is high, but large cap it is lower compared to this, and here it is lower. Basically, again, this ratio is to tell for every unit of returns that you get, how much risk you took, right? Which means if you have got high returns, but you have taken less risk, it's a superior product. And that is what it is telling here. Let's take a look at the volatility. Now, uh, the large cap from 5 years to 10-year period, the volatility has gone up. But here, the volatility has come down. And finally, let's take a look at all the performance metrics, right? So here, the CAGR, that is compounded returns, are slightly less than large cap in 10 years, but still comparable. It's an equity product. This is a equity plus debt product. Standard deviation is low compared to this. Sharpe ratio is higher, which is better. Risk adjusted, that's higher, better, right? The beta, which means compared to the market, it is less risky, almost as risky as the market. The alpha, which means when you compare with the benchmark, Hybrids have given much more, and the large cap funds on an average have not given as good. So this is the performance measure and the returns, right? So even in a even a 5-year period or a 10-year period, aggressive hybrids have been really, really good, which means you have got very good returns, but you've taken very less risk. That means you did not lose your sleep over in the last 10 years or 5 years, but you still got very good returns. Now, the question one might have is that how about the entry period and exit period? Does it really matter? And that means in the last 5 years or the last 10 years, for example, if you had entered in the market, bought a hybrid fund in 2015, what it would look like in 2020? Or if you purchased in 2016, what would it look in 5 years, or what would it look in 10 years? So this is something very important. How and what about investing for less than 5 years? We have only seen 5 and 10 years. What if I invest for 1 year, 3 year? How will it look? Right? Besides the timing, is it still profitable? Because it is a hybrid fund. And that's what we will look. We will look at 1 year, 3 year, and 5 year rolling data. And I'm going to explain to you what does it mean. So basically, what is this saying is that rolling returns, that means any time if you had invested between 2015 to 2025, in these 10 years, any time if you had invested for a 1 year period, the chances are that you would have got more than 12% in the last 5 years, in the last 10 years for any 1 year period, right? That means if you had invested in 2016 and withdrawn in 2017, this could be the return. And the probability of more than 12% and the probability of between 8 to 12% is so much. And the probability of 0 to 8% is so much, which means there's a high probability that in the last 10 years, mostly it has given more than 12% for a 1 year period. But this is most important. There is a probability, which means at least 10% of the times in 1 year period, it is given negative. You can get negative returns, which means if I invest now in 2025 and in 2026, there is a probability that the markets may go up and down. It is so volatile. I may get negative returns. So clearly, this is not for 1 year. In fact, here, if you see, there's a drawdown. Drawdown means a portfolio which comes down. That means this fund has come down by 32% at in its lifetime. So you cannot invest it for 1 year. Now let's take a look at 3 years. Is 3 year a good period? If you look at 3 year, again, the probability of more than 12% is high, but this is what is important. Most funds show that one in 3 year period also it has given negative. Although the probability of more than 12% is so high in the last 10 years. That means for the future, this can hold true if everything is the same, right? But there is a chance of negative returns, right? So that's why now let's take a look at 5 years. Wow. In the 5 year period, the chance of negative returns has been zero. That means anytime between 2015 and 2025, if you had invested for 5 year period, which means 2015 to 2020, or from 2016 to 2021, or 2017 to 2022, any 5 year period, any month, Jan, Feb, March, April, any month, it has given the probability is 0%, but the probability of 12% is high, above 50%, most of the cases. Here, the probability of getting 0 to 8% is also less. So this is where it lies. 5 years. So here it is very clear that, so in a 5 year period, the chances are zero. That means if you invested for 5 years in any of this 10-year period, if you'd invested for 5 years, your probability of getting negative returns was zero. That means you would have never got negative returns in 5 years. Now, something very similar I have done for large cap, mid cap, and small cap. Please watch that video. You can see the the thumbnail here and the title. Watch this video where I have actually mentioned in large cap, mid cap, and small cap what is what is exactly this rolling returns. What is the outcome of this rolling returns? What is the period when you will definitely not have negative returns? So watch that video. So this clearly tells us that you should never invest for 1 year or 3 years. The ideal period for investing in an aggressive hybrid fund is 5 years. And what about SIP returns in the last 5 years? Let's take a look. So I've just taken some of the top funds and I've seen I've generated this SIP returns. So 60 installment, that is 5 years. You invested 3 lakhs. This is the current value. That means this is the total growth. That means you got in the last 5 years, you got 1.37 lakhs additional here, 1.49 here, 1.66 here, and 15, 16, 17% returns, compounded returns, 17%. What, what a fund category. If you had invested, you would have got probably more than many of the large cap funds in the last 5 years. Now, the big question that you might have is, how is it that despite taking low risk, less risk, despite having debt funds, how is it that these funds have performed better than an equity fund? In fact, better than a lot of the funds have performed better than the best of large cap fund. How is it possible? Let's take a look. So this is the reason. It has exposure to mid and small cap. And I think this is the game changer which actually makes the hybrid funds more attractive than the large cap funds. These are the two things: the mid and small cap exposure and the debt component. And it is not just from 2020, even from 2015, the funds have performed in the similar manner. That is because, so this debt component actually gives stability and also allows managers to book equity profits at peak. That means if this is equity and this is the debt fund, and if the equity goes high, so they book the profits and put it here. And this is a stable component. And the mid and small cap actually perform better in a period of 5 years or 10 years, which is better than the large cap. And that is why we have aggressive hybrid funds giving better returns. And here, there's a dynamic asset allocation flexibility, which means some funds shift between equity and debt based on valuations, which boosts returns. And finally, the large cap funds have lagged because they are concentrated on big companies. This is the reason why aggressive hybrid funds are attractive and they give better returns. Now, let's take a look at what is the composition of these funds in terms of large cap. So here you've got, so they still have, so these are the 3 funds I've taken. They have more than around 25% in large cap, but they have around 5 to 8% in mid cap, and they have around 7 to 8% in small cap. Now, this is where the game changes for an aggressive hybrid fund. So what are the real benefits of of an aggressive hybrid fund? There's a diversification, lower volatility. There is a tax advantage, outperformance in 5 years horizon. Even in 10-year horizon, it is not bad, almost the same. And there is a rebalancing done by the fund manager. And the investor does not have to do all that. This is done by the fund manager. And that's why this is that's why aggressive hybrid funds are extremely good. Now, the last question which we need to address is, then who should be investing and for how long, right? What kind of investor, uh, what kind of investor you should be? If you're a young couple, should you be investing? If you are in your 40s or in your 50s, should you be investing? And if you invest, for how long should you invest? What is the time horizon? We have already seen less than 5 years is risky, right? So let's take a look at who are the type of investors. First time mutual fund investors. Now, if you have never invested in mutual funds, try this, because you will not see it go up and down as much as an equity market because of the cushion which provides. There's a cushion of debt fund. So a first time mutual fund investor, probably this is the best fund to enter into. It gives you good returns without you going through the roller coaster. Conservative equity investors, which means if you are an investor who's conservative, you can't take much risk, go for aggressive. You won't see that volatility. Your emotions won't be stirred up if you invest, if you're a conservative investor. Risk averse equity seekers, which means you want exposure to equity. Obviously, 10-15% returns, who doesn't want? But then you don't like risk. This is the best fund. If you have financial goals 5 to 7 years, ideal. For example, if you have your children's education happening in the next 5-7 years, aggressive is very good because you don't take too high risk. If you are if you want to buy a house or a car in between 5 to 7 years, ideal fund. And then if you are an aggressive, that means you take risks, but you have only 3 year or 4 year horizon, not 5 years. 3 years, you can take a risk because in 3 years, the probability of getting 12% plus returns is quite high. 50-60% we have seen. That means if you can take that risk, that means it is possible that you may get negative also returns. But then since you are a high profile, high risk, and you probably have something coming up in 3 years and you want to take a bet, this is the right fund for you. In fact, I have done that. I have invested in an aggressive risk profile, aggressive hybrid fund when I had a time horizon of for 1.5 or 2 years. I said, let me invest. And I did see it go negative, especially in 2024. I did see it going down. But then I saw it again coming up in 2025. It didn't bother me so much because I can take higher risks and I have tried it. But trust me, after doing this analysis, I felt probably I should have done this more often, and I missed it because instead of investing in a debt fund or a long duration fund, I should have tried this, and this has been an eye opener for me too. So this is a some insight into an aggressive hybrid fund. I hope learned you've learned something new about an aggressive hybrid fund. If you ask me, I have learned definitely, and what I'm sharing with you is only a fraction of the analysis I have done. There's a lot of analysis I have done, which obviously I cannot share it here because of paucity of time. But this is a category of fund no one can ignore. You can ignore debt funds. You can ignore some of the other hybrid funds. You may ignore, maybe small cap funds, but this is a category which you cannot ignore. Some of the categories I feel as a mutual fund investor you should never ignore, where you want to good returns and also stability, is flexi cap, large caps, mid caps, and this is the category. I'm not a big fan of small cap, but these are the categories which I believe are the best among the best categories to give you good returns at a good, with a good risk adjusted returns, and for a longer period. Like, so you can start with aggressive hybrid for 5 years, then you can move on to large cap and mid cap and small cap, flexi cap. So this is the way you can go, and I hope you will make an investment in the aggressive hybrid fund. Let me know, have you already invested? Or if you have not invested, will you now invest? What do you see as advantage in this fund, in this type of this category of fund? In fact, I am now interested in actually getting deeper into the hybrid category just to find out which type of investors and for what time horizon is are the hybrid funds category, because this is probably a neglected category, at least from my perspective, because we either look at equities or we look at debt. But hybrid is a great category. I hope there is some learning for you. Let me know by showing me a thumbs up if you have learned, and if you feel that this is not something which benefited you, you can show thumbs down. But please let me know in the comment box what you liked, what you didn't like. And if you have not subscribed to my channel, please subscribe. I encourage you to subscribe. I continue to share in this channel for young families. My focus is young families, wealth, and relationship. Thank you for staying till the end. See you soon.